Good morning, good afternoon, and good evening, wherever you are. It's great to be back with you. Hope you are doing well. Here we are together, another episode. I hope you are having a wonderful week. I am your host. You can watch and listen to me on YouTube, Rumble, and X. I create these videos in the style of classic radio, so you can listen while working out in the gym. Hopefully, you're working out in the gym and listening to this at the same time. I know I will be, of course. As I've explained before, I pre-record these for the weekend and then I post them later in the week. So I will be heading to the gym in a little bit and I will be reviewing this video. Of course, I only do these videos in one take. I don't do them over again. I don't edit them. What you hear is, hey, that's the one shot I get. I want this to be as natural as possible. Of course, you can listen to these while you're going for a morning, afternoon, or evening walk around the neighborhood. It's a good time. Get your steps in, your 10,000 steps, or while you're doing chores and cleaning the house over the weekend. That'd be, or during the week. Maybe you like to do it during the week. In the when I was stationed with the Marines, we'd have field day every Thursdays. So Thursday night's a wonderful night to clean, as uh, as we would say. Of course, the activity is up to you. I'm just glad you choose to include me in your activity, whatever that is. Please like, share, and subscribe, of course, because it does feed the AI algorithm. And finally, please post your comments and questions below. It'd be wonderful to hear from you. And let's jump right into it as I share this with you. This from CNBC. Uh, Title of the article: Why Combinator Startups Are Fastest Growing, Most Profitable in Fun History Because of AI. So, the previous video, which I published before this one, that one was on why AI startups are failing at alarming rates. Why 90% of AI ventures die within the first year. So that was in the previous video. So this video might seem, as I read through it, might seem to contradict the previous video. It does not. It does not contradict the previous video or the previous data. So if you're reading through this article quickly, you might say, "Oh wow, what is Doc talking about?" No, it's complete BS what he was talking about in that previous video. No, this doesn't contradict it at all. These are different pieces of data. That's what's happening. And as we dig into the data, when you read articles and they give you a piece of data, you can actually dig into that data. You don't need much data to dig into it and see what's going on. And I also give you some other insights from an engineer, from a grunt engineer perspective versus what you're hearing, because you're going to be hearing a lot of management speak. And again, as you see there, pretend VC. I am not a VC. I'm a pretend VC. Just want to get that correct. So this article is by, so let's get on to this article. Is by Kate Rooney. It was just published on March 15th. So just yesterday. Key points. Y Combinator CEO Gary Tan says for about a quarter, not all, for a quarter of the current YC startups, 95% of the code was written by AI. 95% was written by AI for 25% of the YC startups in the group. As they do these by groups, and it lasts for about 9 months. And not to bury the lead, but they do only 1% of all the startups that apply to this program get in. Let me say that again. All the startups that apply to this program, only 1% get in. So it's a filtering system. And of course, they're going to take the ones they think are going to be the most successful and drive the most revenue, maybe get some profits at the same time. I mean, that's the end goal of this, is to profit. Of course, if you profit, you get to keep your job. Um, so you don't need 50 to. So he says here, uh, key point number two. What that means for founders is that you don't need a team of 50 or 100 engineers. Tan said you don't have to raise as much. The capital goes much longer. By the way, I've interacted with Gary a couple times on X. He seems like a nice guy. We both believe in a lot of the same market ideas. I don't know if he's a libertarian like I am, but we probably agree on a lot of the same stuff. But if you're an engineer, you tend to be more pessimistic about the process. If you're a project engineer or a manager, or you're somebody who's putting money into the venture, you're not going to be pessimistic. You need to be positive about it. And so there's trade-offs and benefits to being both. Like I said, he seems like he's a nice guy and he's trying to do the right thing. He and I both agree on math education. So if it sounds like I'm dumping on him or dumping on their why and their combinator, I'm not. I'm just being an engineer about this. So which means I'm going to be a bit more pessimistic. It also means that I'm going to go through this article and I'm going to point some things out. The dog not let me see if I can say this correctly. The dog not barking, so to speak. That took a lot of energy to get that out. So I'm going to repeat this. He says what that means for founders is that you don't need a team of 50 to 100 engineers. Tan said you don't have to raise as much. The capital goes much longer. Right. You don't need 50 to 100 devs or software engineers for 25% of the YC startups in their program. Not you don't need 50 to 100 engineers for a company outside of that program. Because this is data within their program. This is separate. This is a subset of the market. What they're doing. Again, they're already filtering. There's no filtering. Well, the market has its natural filters. So let me put this another way. You need 50 to 100 engineers for the other 75% of the companies in the combinator. I mean, they're probably not doing that, but that's what that stat would mean, right? That's it. And then another question is this reproducible? So they go through this group for 9 months, and this group, 25% of them, 25% of the startups in this group, their software is being generated by AI. 95% of it is being generated by AI. For this group, not the next group and not the next group after that. For this group. So if it doesn't happen in the next 3 or 4 groups, that's a fluke. But if it happens, again, it's only 25%. It's not 100%. It's 25%. Now, how does that compare to the rest of the market? I don't know. I don't have data. I don't have access to that data. I would like to have access to that data, but I don't. But if this continues at this rate, 25%, then that's reproducible. But again, in order for this thing to be validated, it has to be reproducible. If it's not, then it's just a data point in an article to generate clicks and views. That's all it is. Again, I'm not trying to poop on the guy's head or anything like that. It's just, it's not my incentive to generate money for him and to give him, to shower him with, that a boy, good job, guy. It's not my job. And I don't want to read this article and just read it and give anybody who's people listen to this This, I imagine now, I have a few people who listen consistently, and they have a certain expectation of what Doc's going to provide to them in my content. It's going to be a different perspective. I, as you know, I try to be as courteous about it as possible and respectful. Again, my interaction with him was positive, so it's nothing against him personally. And like I said before, he has an incentive to show to show the best face possible for what they're trying to do. And by the way, 25%, that can be really good compared to the rest of the market. And if it is, they should take that idea, turn that into a business, and then help all the rest of the companies in the market. That would be a business idea. But that's a topic for another day. Anyways, point number 3. For the last 9 months, the entire batch of YC companies in aggregate grew 10% per week, he said. The keyword here, or keywords, is in aggregate. In aggregate, grew 10% per week. Compared to what before? I don't know. I'm guessing it was better than it was before, which is good. That's good. But this means each YC company, Y Combinator company, grew at a different rate. Because again, they grew in aggregate 10%. It's not each of them grew 10%. It's in aggregate, they grew 10% per week. So each of them grew at a different rate. I don't know this for sure, but it might be the case that some of them didn't grow. And this also begs the question of, if they grew, are they growing in revenue? Are they growing in profit? I imagine at this point in the stage, you're probably just, since it's AI, there's going to be more cost is going to be. Remember, we talked about in the previous video, hardware versus software, the cost, and AI is going to act more like a hardware company, which means it's going to have more, it's going to require more capital. And so if we're on Shark Tank, Mr. Wonderful, he would ask the question, what's your burn rate? How much are you burning? Damon John, he would ask that question as well. And you should watch that show. It's a good show, especially if you like this. There's Gary. So the article begins. Silicon Valley's earliest stage companies are getting a major boost from artificial intelligence. So again, they're trying to figure out, I imagine some of these companies might be AI companies. Some of them might be trying to implement AI into their business model. Article continues here. Startup accelerator Y Combinator, known for backing Airbnb, Dropbox, and Stripe, this week held its annual demo day in San Francisco, where founders pitched their startups to an auditorium of potential venture capital investors. All right, so as we'll find out later, the Y Combinator will invest and take equity, and then later on, as they pitch, they can, to these capital investors, they will also, if they can convince them of the business model and the market value, and that there's a target market there, then they will also invest and they'll further take equity, which dilutes the founders' interest in the company. And of course, if you watch Shark Tank, this isn't new. You see this play out week to week, because that's what's happening on Shark Tank, right? They'll come in, and the person, the owner of the business, will ask for, let's say, 100,000, 10%. And so that's the shark, that's their opportunity to be able to buy in to the company, and then they get 10% of the equity for 100 grand. And that values, if I'm doing math correctly, if I remember, it's been a while since I watched Shark Tank, if that would value the company at $1 million. And of course, Mr. Wonderful would always say, well, how much revenue are you generating and how much profit are you generating? Because Mr. Wonderful wants to get his money back as quickly as possible. Then that's when they get into burn rates and all that stuff. Again, I think the show was valuable enough where I actually purchased the episodes on Amazon and watch them, because I'm a cord cutter. I don't have regular television. So I think the show provides that much value for me. And of course, understanding business and these types of things actually does help me as an engineer in industry. Because if you're building a product, the product has a value, has a price value, and you got to know what pain points that product addresses, and then how much the customer is willing to pay for that. That's something that's important to know as an engineer, not just a project engineer, senior project engineer, but actually as an engineer as well. Those types of things are important. Let's continue here. Y Combinator CEO Gary Tan told CNBC that this group is growing significantly faster than past cohorts and with actual revenue. So again, I asked the question with revenue. He doesn't mention the word profit. So I get asked the question, how much are they burning? You know, what is their burn rate? Again, I've asked those questions, just asked those questions a couple of minutes ago. Excuse me. But these are important questions. And then, of course, you know, what's the success rate of these companies compared to the rest of the market? In the previous videos, 90% were failing. So are they seeing the same trend within their cohort of companies? 90% of them are failing. What does that tell you? I don't know. Well, it tells you that 90% are failing, but there might be a greater significance to that. And by the way, that, as we learned in the previous video, that 90% is higher than traditional software IT companies, and of course that's higher than franchisees. And another interesting question is, how is, you know, will there eventually be an AI franchise, and how will that do compared to traditional franchises? Or are the franchises with that implement AI into their companies more successful than the franchisees that don't? Or does AI just become so common like a regular computer, it doesn't matter? It's like that. I mean, you could ask the question: what companies that use computers, are they more successful in company than are franchises that use computers more successful than franchises that don't use computers? It's become one of those questions where it's like, well, is there? You'd have to ask the question, the follow up question: is there a franchise that actually doesn't use a computer? Then that question becomes null and void. Article continues here. For the last 9 months, the entire batch of YC companies in aggregate grew 10% per week. Yeah, we already covered that. That just means that they each grew at different rates. Remember, I'm an engineer. It is my job to be pessimistic about these things. It's not my job to, you know, put the best foot forward for this Y Combinator. And by the way, I had the opportunity to join not this Y Combinator, but in a previous venture, I had an opportunity to join a Y Combinator. And so I understand a little bit of um, the process for getting in. And it just wasn't for me. It wasn't something that I wanted to take on. I was too busy building. I had my own vision. And the thing is, if you get into that, then you have to change your vision and all that. Well, you know, pivot, so to speak. Let's see here. Article continues. It's not just the number one or two companies. The whole batch is growing 10% on week on week, said Tan, who is also a Y Combinator alum. That's never happened before in early stage venture. Again, they are growing in aggregate, which means they are growing at different rates. That's fine. And again, if they're growing quicker, if they're getting, basically why this is important, because they get the market faster, because they might have competition. If you could get the market faster, then you could take more territory and then defend against competitors. I mean, that's a capitalistic market. It's the best economic system we have. It's the most optimal economic system we have. It's not fair all the time. There's no such thing as a fair economic system, but it does provide the most opportunity for anybody who seeks it out. And it takes a certain mindset too. Let's see here. He says that growth spurt is thanks to leaps in artificial intelligence. Tan said. So I would ask the question: are we assuming this is the reason? And you probably read this article. Of course, he said that. Of course, that's the case because he said it. If I, as an engineer, can't just because he said it doesn't mean it is. I would ask the question: what inputs into the system have changed? Now, it could be the case that it is. The artificial intelligence is the key factor here for their growth. As long as their systems and processes are the same, administrative type stuff, SOPs, things like that. But we don't know because these articles just don't provide us with enough information. But those are the types of questions. Those are the types of questions I'm going to ask. I ask those questions a lot, actually. But let's continue here. Let's see here. Article continues. App developers can now offload or automate more repetitive tasks, and they can generate new code using large language models. Tan called it vibe coding. Here we go. These terms. I don't use these terms in industry. I ignore people who use these terms. We call it vibe coding, a term for letting models take the wheel and generate software. In some cases, AI can code entire apps. So okay, so then what is the error rate for bugs in the AI generated code? The AI code's not going to be perfect code. It's not a thing. If you know anything about what's going underneath the hood of AI, that's not a thing. It's not going to be perfect code. And then how's that code going to compare to code generated by humans? Is the error rate for bugs or the bug rate going to be higher for humans or is it going to be higher for AI? So the code's not going to be perfect. So how much time is it going to take to go back through that AI code? I hope they're going back through the code. And I hope they're testing the code. Again, the reason why I say management speak when Tan says these things, I refer to Sam Altman. He uses management speak. Elon Musk uses management speak. It's because the engineers in the foxhole, the engineer out in the field is using terms like test, review. There's certain words that engineers use that management doesn't use. We use a different set of words. And so Tan isn't using the word like test. We test that code. We validate that code. We verify it, then we validate it. I'm not hearing terms like that. So that's what I would expect. So AI generated 95% of the code. We reviewed that code, we tested that code and found that 94% of that code was correct. So we only had to fix 1% of the code. And we wrote an automated script to automate that process. And that's what I would expect to hear, but that's not what I'm seeing in the article. Just give you some insight into industry type stuff. Let's continue here. The ability for AI to subsidize an otherwise heavy workload has allowed these companies to build with fewer people. Those 25% has allowed those 25%. For about a quarter of the current YC startups, 95% of their code was written by AI. Tan said. Again, remember, for 25% of the YC startups, 25%. I just want to make that clear because some people are going to read this article and it's going to think, oh, well, they're all doing it. And they're not. That's not what it's saying. Um, the first time I read through this article, I just kind of read through it and write any notes or anything. I was like, wow, this is this is looking really good. Then you go back and you go through it closely and you actually read what they're saying, then you're kind of like, and you start asking questions, and then you get in trouble, and then nobody likes you. Article continues here. That's pretty typical day for me, by the way. Let's see here. Article continues. That sounds a little scary, but on the other hand, what that means for founders is that you don't need a team of 50 to 100 engineers, right? You don't need a team of 50 to 100 engineers for the 25% of the YC startups. That's what he means. That's what he means. I don't think that's what he means. That's what he's saying. So what he's saying here is one thing, but no, what he means is for those YC startups. I hope he doesn't mean this for the other companies in the market that are outside the YC. I hope that's not what he means. Because at this point, we don't know if that's a good idea or not. Because again, he's not using words like we tested this, we verified this, we validated this works. He's not using those terms. That's what I would expect to see. It doesn't matter. I would expect to see those terms for software. I would expect to see those terms for integration of hardware and software. I would expect to read those terms for hardware. It doesn't matter if it's hardware or software. It doesn't matter if it's hydraulics. It doesn't matter if it's an electrical system. It doesn't matter if it's a software system. Those are terms I would expect to hear. We tested it, we verified it, we validated it. We went through this entire process. And then over a 6-month period, AI generated 95% of the code, and the code was correct 92% of the time. I don't know. I'm just making that number up. I don't know if that's the case or not. Based off of this group of the group of YC companies. That's what I would expect. Anyway, let's continue here. Said Tan, adding that companies are reaching as much as 10 million in revenue with teams of less than 10 people. You don't have to raise as much. The capital goes much longer. Right. Well, I question that just because if we're talking about AI companies, it's probably the case with, less people, but I mean, maybe it does. Maybe it does there. Let's continue here. Continue the article. The growth at all costs mindset of Silicon Valley during the zero interest rate era has gone out the window, said Tan, pointing to a renewed focus on profitability. I hope they're trying to be profitable. That focus on the bottom line also applies to mega cap tech companies. Google, Meta, and Amazon have gone through multiple rounds of layoffs and pulled back on hiring. Yes, they have. But I think that also has to do with reallocating resources within the company. So they're changing the structures of their companies. So I'll give you, for example, here in a second. I drink coffee while I do these. At Amazon, they are implementing new types of jobs. They're called mechatronic techs. So mechatronics is a field that is a cross between mechanical, electrical, and software engineering. And Amazon is not only trying to automate its process with software, but also with hardware. You need hardware to move objects. And right now, the way it works is they moved objects with people and with a lot of people. What they're trying to do is they're trying to convert that to moving objects with hardware. So it could be some sort of robotics. Maybe it could be arms. It could be moving robots, something like that. Well, that changes the type of worker. It's no longer a worker who moves boxes. It becomes a worker who maintains the technology. And that's where the mechatronics tech would come in. In addition, somebody needs to build that technology. So Amazon could go to a third-party vendor and build and they would build that tech for them, or Amazon could do it in-house. That I don't know. But I do know because I've talked about this. As a matter of fact, I talked about this, I believe, in my second episode, way last October. You could if you go to the beginning of all my episodes where I talk about Amazon, I talk about this, about how Amazon is implementing uh, opportunities for mechatronics techs inside Amazon, and they're providing a pathway for workers at Amazon facilities to be able to move into that. So if you're moving boxes by hand from place to place, well, now you could get into that program and you could become a mechatronics tech, and then you could start maintaining, fixing uh, hardware, equipment. I don't know if it'd go as far as software, but yeah, I don't know that much about the program. But it is an opportunity. So Amazon is changing. That's an example of how Amazon is changing their structure. They're becoming more technology based, so to speak. And it could be the case that part of the layoff was um, they were doing so good that they were just over hiring in non-technical jobs. It could be the case, and they needed to draw that back. For one, there was no need for the company, and two, it was digging into their profitability or into their revenue. And sometimes it's not always for profit. Sometimes it's just revenues coming in, and they want to reallocate that someplace else, or their revenues coming in, and whatever's left over, I guess that would be their profit, and they want to reallocate that someplace else. So I guess that would be profit, even though it's not always about profit, but in this case, it probably is. I guess it depends on if they take it out after or before, how they spend it. That I don't know because I don't have access to their spreadsheets. Anyway, it's my personal opinion that Amazon and other companies are reallocating their resources and they're restructuring. They're changing as businesses and they're adapting to market forces. That's what's happening ultimately. So rounds of layoffs, pull back on hiring. Doesn't say in this article why. That's why I think what's going on. And again, I would ask, regarding the YCs, what is the current profitability of the 25% of YC startups compared to the other 75% of the YC startups in the program? Are they actually generating a profit versus the other ones? That's a question I have. And the article does not answer that question. So we'll continue here. Why that's shaken some engineers, Tan described it as an opportunity. I guess my question is what engineer is shaken? There's a lot of data Tan has not shared with us. Of course, I said that a couple times now. So far, I'm just hearing management speak, and I've said that as well. I'm just hearing management speak. Continues, it's easier to build a startup, and the top people in tech don't have to prove their worth by going to work at big tech companies. No, you don't have to prove your worth by going to work at big tech companies. Top people don't need to work at big tech companies. The United States is a large marketplace with a lot of opportunity. You probably won't make as much money. You'll make more money if you go to the big tech companies, but you don't need to go to the big tech companies to be a successful engineer in industry. This I know for a fact. There's a lot of opportunity in the market, and you could do one thing for 5-10 years, and you could also switch and do something else as an engineer. You don't need to keep doing the same thing. I know somebody who's currently making a shift, changing to something different, a different technology stack, as we would say. He's moving on to something different. Article continues here. There's a lot of anxiety in the job market, especially from young software engineers. Tan said maybe it's that engineer who couldn't get a job at Meta or Google, who actually can build a standalone business making 10 million or 100 million a year with 10 people. That's such a powerful moment in software. Yeah, I think AI is definitely changing the game there. First, whereas it's providing more opportunity. If you can harness that opportunity, then you could do pretty well as an entrepreneur, and you probably don't need as large of a staff. But I would ask the question, are you a software engineer listening to this video or watching this video right now? Do you have an anxiety? If you do, post your anxiety in the comment section below and let's get the discussion started. I want to hear why you're anxious about the market. What are some of your pain points, so to speak? What are some of the issues you're having? Maybe you have a job and you're just anxious. The thing is, if you have a degree and you have a degree that says engineer on it, you're not stuck. And remember, the best time to find a job is when you have a job, especially when the job's going really well. That is the best time to leave. And you ask the question, well, Doc, wait, why? It's going really well. Yeah, right. Because your attitude, if your job's going really well, you're going to have a positive attitude when you are in um, you're going to carry that over to your next set of interviews for new potential jobs. That's going to carry over. If you're negative, if your job's not going well, you're going to be negative. You're going to likely carry that over to your interviews. And if you don't have a job, you're probably going to have a negative attitude. You're going to definitely carry that into your interviews. You want to go into your interview with a positive attitude, which means you want your job to be going well. That's the best time to jump ship, is when everything is going well. That is the best time to jump ship. Anyways, if you have some anxiety, post that in the comment section below. I'd love to hear from you. And let's get that discussion started. And let's continue here. About 80% of the YC companies that presented this week were AI focused, with a handful of robotics and semiconductor startups. Robotics and semiconductor startups are going to require capital. Remember, that's hardware. This group of companies has been able to prove earlier commercial use compared to previous generations. Tan said that's good news. But my question is, what percent of the 80% of the companies that presented, or what percent of the companies that presented were from the 25%? That's what I want to know. And that's the information that's not being provided. But those are the types of questions I ask, and that's probably the reason why you watch me. It's because I ask different types of questions. Article continues here. There's a ton of hype, but what's unique about this moment is that people are actually getting commercial validation. It's great news. He said, if you're an investor at demo day, you'll be able to call a real customer, and that person will say, yeah, we use the software every single day. That's good news. By the way, I don't want these companies to fail. I want them to succeed. But I'm also realistic. I'm practical. I'm not going to look at things with rose-colored glasses. See the world for what it is. Entrepreneurship, as we've, over this last article, I've talked previous articles about entrepreneurship and technology. There's a lot of failing going on. There's a lot of churning going on. And that's a feature of the system. It's not a bug. It's probably the best we can do. And part of that is just human nature. You let people take a run at it. Most of them are going to fail, but the ones who succeed, they succeed. Again, it's the best system we have. That's, of course, not as good as a good batting average, which is 300. In this case, that's 25. So it'd be 25. Be a 250 batting average, but a little inside baseball there. I'm talking about the percent. If 25% are the ones that are actually succeeding, that'd be a 250 batting average. A good batting average is 300 and above. That's a good batting average. Let's see here. He says, article continues, Y Combinator was founded in 2005 by Paul Graham, Jessica Livingston, Robert Morris, and Trevor Blackwell. This is what I was talking about before with the firm investing, with YC investing in the companies initially. The firm invests $500,000 in startups in exchange for an equity stake. Right, they're going to take some equity based off of this. That, by the way, that was another reason why I didn't want to join at YC, is because I didn't want to give you my equity away for what I was building at the time. I did all the work. I didn't think, well, I'm not going to get into it. There's a lot of reasons why I didn't join it, but that was a part of it, was the equity. Because they take out equity and somebody else is going to take out equity, you're going to get diluted, which I'll talk about here in a sec. Those founders, the article continues here, those founders then enter a 3-month program at the San Francisco headquarters and get guidance from partners and YC alumni. That's right, they get a lot of attention, they get a lot of nurturing. So ideally, their success rate should be higher than compared to the market. And then, of course, it continues here. Demo day is a way to attract additional capital, right? So the firm invests the initial $500,000. That decreases their equity, depending on the value of the company. If the company is only worth $1 million, they already lost 50% of their company, the equity. If their company's worth $2 million, then they've lost 25%. You can do the math in your head from there, but that dilutes, right? And then afterwards, they go through another round and they get further diluted. And so then the question is, what does that do to the psychology of the founders? Because again, when you started this, you had 100% ownership. Now you gave a piece of that ownership to somebody else, and to somebody else, and to somebody else, and then to the point where you might have 10% left. And what does that do to your motivation? What does that do to you psychologically? I mean, those are things that need to be, if you go into, let's say, a Combinator, those are things that need to be, those questions need to be asked. What does this do to your motivation long term? If you, again, going back to the Shark Tank example, if you watch enough Shark Tank, you know that there are companies that have come in with maybe like 15, 20% equity in the company. And they're trying to get a shark for 2%, 3%, 4%. And the numbers are just not going to work. And then, but they take off another 4 or 5%. They're probably going to get more than that. You take half that. Now the person only has like 7.5%. So is it really your company at that point? Or are you now just an investor? You're investing your time. Yeah, how far does this go, so to speak? Let's continue here. The firm has funded more than 5,300. Oh, I see a typo there. That should be 5,300 companies, or is it 53,000 companies? I'm assuming it's 5,300 companies. See that nice little. Somebody did not review their article, or maybe missed it. That would be the editors. Anyways, the firm has funded more than 5,300 companies, which it says are worth more than $800 billion in total. I'm guessing there's probably a handful of companies that are worth that hold the value of that 800 billion. Maybe like 700 billion of it is like it's a handful of companies. The rest of them are all smaller. That would be my suspicion. Article continues here. Over a dozen of them are public, and more than 100 are valued at 1 billion or more. Right, 100 out of 5,300. It's kind of where I was going with this. More than 15,000 companies apply to get into the accelerator, with about 1% acceptance rate. This is what I was talking about earlier. YC is a natural filter. It's a filtering system. And of course, they're only going to take the most promising startups. They're going to take the startups that are most likely to succeed. So, is this a fair comparison of the market? So, in the previous video, it was 90% of the AI companies fail within the first year. But with this system, they're filtering out companies and they're taking companies they think are the most promising. Asking the question, what do you think? Is that a fair comparison for a data set? Can you compare those data sets? You let me know in the comment section below. I'd love to hear from you. Let's get that discussion going. You tell me, is that a fair comparison? How many of the companies are still in business? Right? That go through these YCs. How does their success failure rate compare to the rest of the market? And so I just asked that question. It's an important question. It says something about the YC. If their companies are more successful, it means the YC has value. Again, I'm not trying to dump on the YC. That's not my point. Not what I'm doing here. So if it sounds like that's what I'm doing, that's not what I'm doing. I'm asking questions. Say I have a startup. You have a startup. You have an opportunity to join a YC. These are the types of questions you should ask. Because if their success rate is higher than the market, that's a consideration for giving away equity. If you want to do that, that's a consideration for that. That's not a knock on the YC. That's in their favor. That's in your favor. That would make me more likely to give away equity if that's the case. If they can show you those numbers. If they're willing to show you those numbers. Anyway, let's continue here. I mean, just ponder on that for a bit, in the rest of the questions I've asked in this. Article continues here. More of these venture capital incubators have popped up throughout the past decade, and more capital has flocked to early stage startups. By the way, I think that's a good system. Ideally, that should help them. It should increase the odds of succeeding. Although, if you watch Shark Tank, they'll tell you bootstrap it and figure it out. Bootstrap it and figure it out. Keep your equity. Write a good marketing plan. Make your business model simple. Focus in on a specific target market and just start driving. Well, first you want to make sure that target market, remember we talked about in the previous video, make sure you want to make sure there's a market out there for you before you start driving your business. You want to make sure there's a market for you. You want to make sure people are willing to give you money, and in fact they start giving you money before their products. They think it's such a good idea they give you money before the product is even built. But they get the product first. I think Tesla did that. There's a lot of companies that do that, but Tesla is the one that comes to mind just because I don't hear about a lot of the other companies. So that's the trade-off. You give capital away for equity, or you don't take capital and you bootstrap it and you keep your equity. And then you want to say, well, am I going to be as successful as the Y Combinators or not? And sometimes it doesn't even matter. Sometimes it's all about the entrepreneur and how much, how motivated they are and how good they are at adapting and meeting the market demand. Anyway, let's continue here. Again, I'm not a VC. I'm a pretend VC. I'm a pretend VC, not a VC. There's a lot of things I don't know about VC stuff. Although I'd like to talk to a couple of VCs. I think that'd be fascinating. Although they might not like how I refer to management speak. They might not like that. Let's see. Article continues here. Despite the competition, 10 argued that Y Combinator has an edge thanks to its strong network. Right. And that might be the differentiator right there. It just has a strong network. And we're going to get to why that's important here in a second in the next paragraph. He pointed to the number of highly valued portfolio companies rising and pushed back on the idea that specialized incubators were taking business. Like I said, I agree. I agree. A network is powerful. I already agree. I said I agree with that. Is your potential worth is basically that. Article continues here. It says about 20 to 30% of the companies during YC changed their idea and sometimes their industry entirely. Right. They have a lot of these VCs and alums. People have done this before. They've gone through the process. They have an idea of what works and what won't work. And so they can help these new companies, these new startups pivot to something else that increases the odds that they'll succeed. And that's the power of the network. I don't want to forget that part. That's the power of the network right there. That's the power of the network. If you're some startup in Missouri, you don't have that network. So that's a disadvantage for you. I'm assuming. Maybe Missouri has a good network. But does it have the network of Silicon Valley? People go to Silicon Valley for a reason. Or San Francisco. That's because Gary is stationed out of San Francisco. Anyway, article continues here. And if you end up with an incubator that is very specialized, you might not be able to change into the thing that you were supposed to, Tan said. We think that the network effects and the advantages of doing YC have only become more bold, right? Again, this is not a bash on YCs. This is just an analysis of YCs in this article. So there are obviously benefits to YCs, but there's always a benefit and a cost. The cost is if you succeed, you're going to give away equity. There's probably other costs as well that I can't think of, but there's always benefit and costs. Always. There's always trade-offs. There's always benefits and costs. Opportunity costs, stuff like that. Those things always play. So you always have to consider those no matter what kind of business you are building. Doesn't matter if it's a taco truck. Tacos sound really good today, by the way. It's early in the day for me, so maybe I'll do tacos later. But it doesn't matter. That does not matter. So that's the article for today. Let's see here. I'm going to real quick. I did not put this on my agenda, but I'm going to do it anyway. I'm going to shamelessly promote Circuits FM. Let's see here if I go to it. Let me go. I'm just going to replace real quick. Here we go. I'm going to shamelessly promote my second channel, Circuits FM. This is all the images and so I generate AI music. I was a musician in a previous life. Come from a music family. Oh, that's Triangular Fusion's doing really good. 132 views. Cool. I do have a musical background. I come from a mother's side's very musical family. I can play instruments. I've been playing instruments for a long time. Guitar's my main thing. Lead guitar. I play everything from metal to progressive to classical and jazz. And so now I've become kind of a composer with AI, a producer and a composer. So I compose AI music. And I also generate the images. All that is AI generated as well. So if you're interested in, right now, a lot of this is metalcore, although Triangular Fusion is kind of a fusion between metalcore, synth, and new age music. So it doesn't quite have the aggression that traditional metalcore. It's a little bit more laid back, which I like. But this Triangular Fusion's about, anyway, you can read the story there. I also have some other stuff coming up, which is more like, I guess you call it dubstep, folk, rock music that I'll be publishing soon. And I also have some more synth, house, new age / type of music. So I do different types of music as well. I might even try to venture into composing some AI or some classical with AI as well. So we'll see what happens with that. Anyway, I thought I'd just share that with you. I'd appreciate a subscribe or a follow if that interests you, and if I could earn your subscription. In addition, of course, I would also appreciate, I will go to my channel here. I'd also appreciate a follow from you as well. And of course, this is the weekend, so you see I have a new video coming up on Monday, 17th. Of course, this video will be posted on Thursday. You'll get this video Thursday night. But yeah, I would appreciate a follow for both. I had a lot of comments in the previous video. It was great. Get to be able to interact. And so growing, but growing slowly. But I'm growing. And I really enjoy doing these. And I will continue to do these, especially now that I feel like I'm getting into a rhythm of it. And so that's all I got. Were there any questions you thought I should have asked? Were there any questions I missed? You thought I missed? If so, please post them in the comment section below. It would be I would love to hear from you. I'd love your feedback. Let's start the discussion on this topic today. If you want to talk about something else, throw it in there as well. Let's talk about it. In addition, please like, share, and subscribe, because it does feed the AI algorithm, and it does help the channel. Commenting, liking, viewing, sharing, subscribing, that all helps. I might have said one of those twice, but it all helps. It's all important. So again, I appreciate you as a viewer. I appreciate you continuing this journey with me. With that said, I will see you in the next episode.